Hello, my friends. Brett Pattison coming at you from the financial capital of the West, Salt Lake City, Utah, joined by the chairman.
How you doing, Brett?
You know, Brian, I'm good.
Good.
I'm good.
I'm glad.
We've had a lot of things happening in the market that we need to discuss today. First off, before we discuss the topic of the day, let's do a market update, which this is actually kind of fascinating. Year to date, we're off the lows by 5 or 6%, as a heads up. S&P down 19.7% on the year, so close to 20%. NASDAQ down 31%. So a huge difference between the NASDAQ, which is more tech-heavy, and the S&P 500. Here's the crazy thing, Brian. And a lot of people might look at that and say, why in the world would you invest in the NASDAQ? It's down 31% versus 20% on the S&P. 10-year returns. I didn't know it was this different, by the way, these 10-year returns. 10-year returns, the NASDAQ, 320% over 10 years.
Those are amazing returns.
Those are insane.
If you put that annualized, that's close to 30%. It's probably going to be a little less than that, but yeah.
S&P 500, and this is what blows me away, 170%.
And that's really good too.
That's really good too.
They're both really
But the
good.
NASDAQ's almost double.
Yeah.
So this reminds me of a phrase, and I want you to explain what this phrase means. From Howard Marks, who we love. He says, volatility is the price you pay for returns. What does that mean? Volatility, because we're looking at a NASDAQ, which is 320% over 10 years versus almost double the S&P.
Yeah.
But it's down 31% this year versus 20% on the S&P.
So, if looking at that chart, there's a lot of you guys, people at home can't see this.
We'll share it on our blog.
There's a lot of ups and downs in that chart. There's a few corrections along the way, and so if you got nervous during one of those corrections, say you owned the NASDAQ, and back in say 2018 or so. We had a pretty good correction. You would have sold out. You would have missed out on a lot of those big returns that we had, since 2018 or so. So it means that you're patient, that you stick with your investments over, kind of difficult times, rough times. And to do that, you're going to experience volatility. So that's what Howard Marks is saying, is that to experience, good returns, you have to be willing to accept market volatility.
And the risk associated with getting those returns.
Yeah.
As compared with bonds, well, with the exception of this year, there's been huge volatility. 20-year Treasury's down 30% this year. But typically bonds are not volatile, but the returns are very small compared to the stock market.
Speaking of bonds, going back to when I was in high school in 1980, really since the early 80s,
I was 3. I'm kidding.
Bonds have been in this really long-term bull market where bond prices continue to go up and yields, the rate of interest that you receive on bonds, has gone down, and it's really been a really long bull market for bonds. Well, that has changed. We're in a new world right now where interest rates are actually going up. Bond prices have been going down, and interest rates have been going up. We've been saying over the last couple of years, we've said it on a podcast many times, that probably the biggest bubble in this market, looking back a year or two ago, if you look back at our podcast, we've said this, the biggest bubble in the market, it was U.S. Treasuries, especially when Treasuries were at under 1%. And just crazy overpriced, and now those same treasuries are paying 4%, and people that own those treasuries, when they're under 1%, and you owned them,
getting hammered.
Yeah, they're down 20+%.
Yep.
So,
which is that long end of the curve? That's that down 30% that I mentioned.
Yeah,
same scenario.
Let me just make one more comment about market volatility and is the price you pay for returns. There's all kinds of studies out there that talk about investment returns versus investor returns. And what's the difference? What's the difference between investor returns and investment returns? Well, the numbers you showed here are investment returns. These are the returns that the indexes have provided if you've been a long-term owner of those indexes. But investor returns are what the average investor, the returns that he actually gets owning, say, the NASDAQ or the S&P over that time frame. And there's a huge divergence between those two.
It's half.
Yeah, it's. I don't have the exact statistics, but
It's
it's something like half.
So if investment returns over time are 8%, investor returns are 4%.
And I've seen in some.
But what does that mean, though?
Well, that means that investors weren't patient. They got in and out of the market. They were timing the market instead of just sticking with it. If they would have just held that investment over the whole time frame and didn't sell it, they would have got the investment returns.
Yeah.
But because they thought they could get in and out and time the market, instead of getting those index returns, they got something a lot less.
I love that, Brian, because that brings up the whole topic for today's conversation, which is preparing for the next bull market during this bear market. That's what we're going to talk about today, and we're going to share a few experiences that we've had as it relates to investor returns versus investment returns.
Yeah.
And I was one of those investors at one point.
We all were.
Yeah.
Everybody had.
Hey,
everybody has to, learn.
Yeah.
Goes through tough times and through experience you learn what works and what doesn't, and hopefully you study and you read and you learn from other people.
Hey, before we get to that, quick announcement. But on November 9th at 2:30, we're having a special webcast just for clients. So at November 9th at 2:30, we'll send out some invitations for it. Right now, we're in the midst of earnings season, and a lot of our holdings that you own as clients have come out with earnings. And each quarter, we're going to have a webcast where we look at some of the earnings on the businesses that we own, and mainly Brian dissects them and talks about the health of the business, future risks, returns, good, bad, ugly, all that kind of stuff. And there's a lot of the companies that we own in the news. A lot of them have done really, really good, and a lot of them have done bad. And so we're going to address that on November 9th.
A few of them have done bad. I wouldn't say a lot.
Did I say a lot?
Yeah.
I'll say this. From a broad perspective, correct me if I'm wrong, earnings have been good.
Yeah, I definitely say that. I think as I look back at our portfolio of companies and the companies that have actually reported earnings, and there's a significant amount, I don't have the exact numbers, but I can think of one where I was really, really disappointed, and that was yesterday. They reported. But the other ones, the market was somewhat disappointed in maybe their growth rates, but the businesses are really healthy, and I'm still very optimistic and bullish on those businesses. Yeah. There's one out there that reported yesterday. Was very.
Dude, its core business did awesome.
Core business was awesome. Expenses are way up, way more than expected.
Let's talk about.
So disappointed there, but we can talk about that.
November 9th.
Yeah.
So. If you're interested in the businesses you own, and so we'll have kind of a prepared presentation for 30 minutes and then do a Q&A. Any questions that you guys have about, or gals have about any of the businesses that we own, we'll address. So, again, November 9th at 2:30. But let's talk about the subject, which is preparing for the next bull market and the bear market. And I have got to share an experience about being an investor. And this goes back before you and I met. 2007, 2008. I was the smartest guy around. I was a genius.
Yeah.
That's what I thought.
In your own mind.
In my own mind. And this is why I say that. 2007, me and a friend, we're looking at the market. We're seeing things crack and, let's short the market, we said. 2007. Late 2007, 2008 roll around. Oh, my goodness, the market's down a lot, and we were doing very well being short the market. In fact, I remember, this is how arrogant I was, which I'm not. I try not to be anymore. I'm driving down the freeway, okay? And I'm in my truck, and I'm driving down to our old office, Thinkorswim offices in Draper, and I'm looking around, and I'm like, oh, you fools, your 401ks, your accounts are down 30, 40, 50%. And I'm just the opposite. You fools. That's what I was thinking. Okay, but 2007, 2008 was great for me. But here's the problem. Okay, March of 2009, market pivots, starts rocketing higher. I'm in bear market mode because the news was just horrendous still. And keep in mind, I had done very well in 2007, 2008. 2009, I was too prideful, okay, and did not want to admit that the bear market was over because I was doing so well. Okay, so this goes back to market timing. If you get lucky enough, and that's what I'm calling it, I was lucky for shorting near the top. But to be a good investor returns, you have to time the top and the bottom. And that's instinct possible. I didn't do it. And subsequently, 2009, 10, 11, my returns were not good, personally. 2007, 8, awesome. 2009, 10, not great. Because I wasn't preparing for the next bull market in the bear market. I contrast that to what you did. Tell everyone what you were doing in 8 and into 9.
Yeah. So I was managing money back then, and client money.
Iron Gate was around.
Iron Gate, yeah.
Yep.
And I saw cracks in the foundation in 07. I mean, just the real estate was just. I kept thinking, this is nuts. Something's going to crack. You heard about how weak the banking system was. We knew that there were potential problems. I felt like there was probably some rough weather ahead. We talked about bumpy air, ahead. I felt like that was pretty obvious. And so we avoided certain sectors like financials and anything real estate related. And had outperformance in 07 or in 08 when the market was down. We outperformed, but we were still down significantly. Yeah. But I went into that with an attitude of, okay, this is my opportunity. I got capital, and I'm going to look for great investment ideas. This is one of those lifetime opportunities where you can put money to work where prices weren't insanely cheap. And it happened. I mean, I didn't realize that it would get as bad as it did. I mean, we were on the brink of the economy off the cliff. Buffett has said that the U.S. economy was in the emergency room, and they had the chest things. What do you call them? Pads,
the electrocution.
The pads. The chest pads on the U.S. economy, trying to revive it. I mean, it was really bad and really scary. But so that was my attitude. Is I felt like, hey, this is an opportunity to buy great businesses when they were on sale, and so that's what we did. And it was difficult to get clients to do that. I mean, nobody wanted to talk about
because
stock.
of the fear.
There was a lot of fear, but
tons of fear.
But for the most part, I don't think I had anybody like sell out of fear. Everybody stayed invested. We did really well coming out of that, and those are the people that put more money to work and bought at those market lows. They saw real incredible gains coming out of that. So
yeah, or even adjust a portfolio. Meaning this: if you're getting out of financials and anything housing related at all, then you have capital then to put in some other things, right? Mm-hmm. And so even if clients don't have new money, you can still, as we do now, with a few positions that we've actually done lately, is, hey, let's sell off of this and buy something that's cheap. But here's the overall thing that you did that I didn't. And I thought I was a genius. You prepared for the next bull market during the bear market.
Yeah. Well, yeah, and part of that preparation is just the mentality, having the right mental attitude. What am I, and what to look for, what type of opportunities, and knowing what to look for. What is an opportunity? What does that look like? Those are some of the things I did to prepare for during that bear market and to buy great investment opportunities during that time.
Did it pay off?
It did. I mean, it paid off really well. And even the people that didn't put new money in, I mean, they stayed invested. And yes, we made adjustments to their portfolio into areas that we felt were really, really attractive. And
Yeah.
it paid off over the next several years, and in a big time way. Yeah.
So I've heard a lot of stories about investors, right? Going back to investor returns versus investment returns. There in 2008, I'm going to get out. I'm going to buy an annuity because it's safe. And they take that enormous capital hit, which is destruction of capital, just to feel safe, right?
Yeah.
Oh, go ahead.
I suspect that there's annuity sales are doing really well right now. I mean, these are the times when annuity insurance salesmen sell lots of annuities because everybody's scared. It's like, I don't want this. I want I want to get out of this market volatility. This scares me. I just want something that's just going to give me a certain rate of return, and I can just forget about it. And a lot of annuity sales increased during the financial crisis, and I'm sure it's happening right now.
I didn't even think of that. You're right. Those vultures are.
This is the time. I mean, I'm sure these guys are going nuts,
Yeah.
selling annuities.
So here's some statistics to put this to put some real numbers on this. This market has been compared that we're in right now with high inflation, rising rates to the early 80s. Okay, and so that's what I want to focus on is just the last bear market that we had that was similar. In 1980, we were down through 82. We were down 27% on the S&P 500. The subsequent one-year return was 43.9. Three-year return was 81.2. 5-year 238, and 10-year 403. So if you can withstand that drawdown of 27% over the next 10 years in this bear market, you're up 403%. I'm not saying that's going to be what happens now. I have no idea. If you look at the average bull market after the bear market, you're looking at 300 plus returns, 300% plus returns. So why, looking back, 2008, 2007 and 8 for me, why in the world wasn't I focused on the next bull market rather than trying to be right in the short term? I lost out in the long term, and eventually pivoted and bought some great companies, and
Did okay, yeah. Well, it's if you're looking in the wrong areas, that's one of the risks. That's one of the things that can happen. And I think you were focused on looking for shorts, ways to make money on a down market. But don't forget that the market over time historically goes up. That's just what it does. And we can talk about the reasons why you have this little sheet here that has all these statistics on what happens coming out of bear markets and the big returns come into the first few years coming out of bull markets or coming out of bear markets. The reason why is businesses continue to grow their intrinsic value. They continue to reinvest back in the business. They hire new employees. They may slow down during a recession, but the businesses continue. So it's like this rubber band effect. You get this, it gets stretched, and then what happens is, the market realizes, hey, this isn't the end of the world. These businesses are going to be okay. And guess what? Oh, wow, these businesses are worth a lot more than what they were 2 or 3 years ago. But you have this down market, and you're buying off of these lows, as opposed to buying off the market highs. When you're buying low, that can juice your returns and improve your returns going forward, as opposed to you're buying at all-time highs and then maybe the market settles down, or we go through a period like we are right now with high inflation, higher interest rates. And
that's a great analogy, the rubber band. It springs back the other way.
Springs back.
In 2007, 2008, you know what? The rubber band was going back, and my hand was right there. And when that rubber band was let loose, my hand was I was short the market. And man, that hurt. It's that rubber band just slapping you. Bam! That hurts. Here's the larger perspective, though. Here's the beautiful thing about living in America, right? And I'm sorry if anybody's down on America, because we're not. We had a presidential election 2 years ago. Whatever side you want to take on that. Now we have a midterm election, and we mentioned this midterm election here in 2 weeks. We mentioned that 2 years ago, and it's hard to believe it's been 2 years, but we mentioned it 2 years ago. And the beautiful thing about this country is that we have the opportunity to vote, make our voice heard, and bet on the future of this company or country, which then we're able to bet on the future of the companies that we own. So if America is going to cease to be America, then you should be worried. But if America's best days are ahead, then the companies that we own, their best days are ahead as well.
Yeah. And we
Do
met.
you want to start singing the national anthem?
We met with a client yesterday. We talked a little politics, and one of the things I told him is, despite who's in the Oval Office or controlling Washington, statistics say that what really matters is that it doesn't really matter if it's a Republican or Democrat in office as far as the stock market.
No, it doesn't.
It may have a short-term effect, but long-term, businesses have done well regardless of who's in office or who has the power in Washington. And that's because we have a lot of great things here. We have an entrepreneurial spirit. We have rule of law. We have the best colleges, best universities in the world. We have the best defense systems in the world. We can now. If you want to sing the national anthem, you can. But there's
My
a
wife
lot.
would kill me if I sang on a podcast.
There's a lot of reasons to be optimistic, but there's all kinds of disappointing things going on in Washington, and I know there's a lot of problems in the world, but there's some things to be optimistic as well.
And the market loves gridlock, and that's where we're headed, is gridlock in the circus tent that is DC. So be excited for that. The overall arching theme is on the journey to gaining your financial freedom. There's going to be storms, there's going to be setbacks, there's going to be flat tires, there's going to be tired legs, whatever you want to say. But that ends, and if you keep climbing, the view is amazing. You just have to sometimes wait out the storm, which is what we're going through.
Yeah. Be patient, endure to the end.
Amen, brother. Amen. With that, my friends, I hope that helps prepare during this bear market with stocks and options. That's what we're doing with both for the next bull market, which I'm excited for.
Yeah, me too.
With that, my friends, until next time, bye-bye.